What if you could, access this whole other world of investing, when it's far away from the daily noise of the stock market?
Yeah, a lot of people wonder about that.
Well, most of us can't actually get in, so today we're doing a deep dive into private equity.
Yeah.
It's this really fascinating universe. Our mission today is just to unpack how this pretty exclusive world works, what it means for the companies involved.
And for the economy overall, right?
Exactly.
So private equity, or PE, as you said, it's basically an alternative investment. The key thing is the money isn't traded on public stock exchanges.
Okay.
Instead, you have these specialized firms making direct investments right into privately held companies.
And that could be anything from like a small startup.
Yeah, funding startups, growth companies, or even buying huge public companies and taking them off the stock market, taking them private.
And it's super exclusive, isn't it? Not just anyone can jump in.
Yeah. No, definitely not. It's mostly for what they call accredited investors or qualified clients. Think big institutional players.
Yeah.
Pension funds, university endowments.
High net worth individuals too.
Exactly. And the minimum investment, often millions of dollars.
Wow. Millions. So it's partly a regulatory thing, yeah. Protecting smaller investors from maybe higher risks.
That's the idea behind it, yes. So the structure involves these PE firms. They're called general partners, or GPs.
ETPs, right.
They pool money together from their investors, who are called limited partners, LPs.
Okay, GPs manage, LPs provide the cash.
Pretty much. But here's the big difference from just buying stocks. GPs don't just sit back. They usually buy big chunks of the company, often controlling stakes.
So they're in charge.
Often, yes. And they get actively involved in transforming the company. It's not a quick flip. They're usually in it for, say, 7 to 10 years, sometimes longer.
Actively involved.
Yeah.
What does that actually look like? What are they doing inside these companies?
Well, it's very hands-on. They might bring in new managers or strengthen the existing team. They push for strategic M&A.
M&A, mergers and acquisitions.
Right, like buying smaller companies, bolt-on acquisitions, to make the main company bigger or better.
Okay.
They'll refine the business strategy, maybe push R&D and innovation, and they definitely look at the finances, optimizing the capital structure, finding that right mix of debt and equity.
So it's about providing, like, patient capital, giving companies breathing room away from the stock market's short-term focus.
Exactly, away from those quarterly earnings pressures.
Okay, that makes sense. Sounds like a long, involved process.
Yeah.
But how do they actually make money? The GPs and the LPs. This brings us to that famous 2 and 20 rule, doesn't it?
It does. That's the standard model, the two-part. That's an annual management fee.
Okay.
Usually 1% to 2% of the total money the LPs committed to the fund. Not necessarily what's invested yet, but committed.
Wait, so they get paid that 1-2%, even if the money's just sitting there, not invested,
Right.
and regardless of how well they do?
That's generally how it works, yeah. It covers the firm's running costs, salaries, rent, research, all that stuff.
Okay. That sounds like it could create some tension if the incentives aren't perfectly aligned.
It can be a point of discussion, definitely. But the 20 part is meant to fix that alignment. That's the carried interest, or carry.
The carry, right.
It's the GP's share of the profits, usually 20%. But, and this is crucial, they only get that after the LPs get all their initial investment back.
Okay, first money back to investors.
And they get a minimum return on top of that. It's called a preferred return, or hurdle rate, often around 8% per year.
So the GPs only get their big payout, the 20%, if they significantly grow the pie for everyone.
That's the theory, yes. It's supposed to incentivize strong performance.
And historically, PE has performed well, hasn't it?
Right.
I've seen figures showing it beats public markets quite consistently over the long run.
That's generally been the case, yes. If you look over long periods, like 20, 25 years, PE funds have often delivered significantly higher average annual returns compared to, say, broad public market indexes.
Those higher returns sound great, but there must be a catch, right? What are the downsides, the risks?
The absolute biggest one, illiquidity.
Illiquidity, meaning you can't get your money out easily.
Exactly. Unlike buying stocks on an exchange where you can sell pretty much instantly, your money in a PE fund is typically locked up.
For how long?
Often 5, 7, 10 years,
Yeah.
sometimes even longer. So if you suddenly need that cash back, tough luck. It makes it completely unsuitable for many investors.
Okay, so big risk there. What about volatility? I've heard PE is often reported as less volatile than public stocks, which seems weird given the risks.
Yeah, that's a really interesting point, and it's quite debated. PE assets aren't priced daily like stocks. They're valued internally by the PE firm, maybe quarterly.
So the values are smoothed out.
That's the argument. Many experts say this lower reported volatility is a bit of an illusion. It doesn't necessarily reflect the true underlying economic risk, just the less frequent, maybe more managed valuation process.
So the ride might feel smoother, but the actual risk could still be high.
Potentially, yes. And some newer research, especially looking at the period since the global financial crisis, suggests that maybe the average PE fund hasn't actually beaten public market equivalents by that much after you account for all the fees.
Interesting. Okay, shifting gears a bit. What about the real-world impact? On jobs, for instance. Is PE a job creator or destroyer?
It's complicated. The overall net effect on jobs seems pretty modest, maybe a small decline nationally, like 1–4%, according to some studies.
Oh, not huge overall.
But underneath that, there's a lot of churning. For example, when PE firms buy public companies and take them private, studies suggest employment often shrinks, maybe by around 13%.
Okay, that sounds like cuts.
But when PE firms buy already private companies from other owners, employment tends to grow, also by around 13%.
Huh. So it's like creative destruction. Jobs lost in some areas, maybe due to efficiency drives, but gained elsewhere as companies refocus or grow.
That seems to be a fair way to put it. It's not a simple story.
But there are definitely negative stories, too. The Toys R example often comes up. That sounds like a case where PE ownership went badly wrong.
Yes, that's a prominent case study often used by critics. After the buyout, the company was loaded up with a huge amount of debt, over $5 billion.
By the PE owners.
Yes, as part of the deal structure. And that massive debt burden really hampered the company. It couldn't invest, couldn't adapt to online competition.
And eventually?
Eventually, it led to bankruptcy, liquidation, and tens of thousands of job losses. It's a stark example of how using too much leverage can cripple a company, sometimes benefiting the PE firm but hurting everyone else.
That's pretty damning. But is it always like that? Does PE ever have a more positive impact, maybe in less obvious ways?
Absolutely. It's not all negative. Interestingly, some studies actually suggest PE ownership can boost innovation.
Really?
Well, patents filed by companies while under PE ownership tend to be cited more often by other patents later on. That suggests the innovation might be higher quality or more influential.
So they might push companies to focus on more impactful R&D.
It seems possible, yes. Providing that long-term focus might allow for more meaningful innovation efforts.
Okay. And looking forward, is the industry changing? I hear talk about ESG and making PE more accessible.
Yes, definitely evolving. ESG, environmental, social governance, is becoming a much bigger deal.
Driven by investors.
Largely, yes. Investors are demanding it, and firms are realizing that strong ESG practices might actually improve returns. Some studies even suggest companies with better ESG scores get higher valuations.
And the accessibility part. Democratization.
Right. Traditionally, PD was just for the big institutions, but now you're seeing new structures emerge, like evergreen private equity vehicles.
Evergreen, meaning they don't have an end date.
Exactly. No fixed fund life. They might also have lower investment minimums, maybe not millions, and simpler mechanics, like no repeated capital calls. It's an attempt to open the doors, at least partially, to a broader group of wealthy individuals.
So wrapping this up, private equity is clearly this major force, right? A world of very active management, long-term money. It can genuinely transform companies, drive efficiencies.
For sure. But it's also undeniably a world of high fees, that lockup or illiquidity problem we talked about.
And some pretty significant societal impacts and trade-offs, like the job shifts and the risks of too much debt, which are getting a lot more scrutiny now.
Absolutely. So maybe the final thought for you to consider is this. As PE keeps growing massively, and as regulators and the public demand more transparency, can these PE giants truly balance that relentless pursuit of profit with, a real provable commitment to creating sustainable value for all stakeholders, employees, communities, the environment, not just their investors?
That's the big question, isn't it? Something to definitely keep thinking about.